Lululemon stock is down over 55% year to date, trading very close to its 52-week low. The big question now is this a great buying opportunity, or is the market telling us something deeper? To find out, we'll take a look at the fundamentals of the company and then run a DCF model to estimate its intrinsic value and potential future returns. Over the past decade, Lululemon's revenue has grown consistently, from around $2 billion to over $10 billion today. Looking ahead, analysts still expect growth, though at a slower pace. Revenue is projected to reach $14 billion by 2029. Profitability has followed a similar trend. Net income has risen from $266 million to about $1.7 billion currently. However, there's a recent negative point. Free cash flow dropped from $1.6 billion to $1.1 billion over the past year. Not disastrous, but worth watching. Analysts forecast that EPS will dip slightly in the next 2 years before rebounding strongly. They expect Lululemon to earn around $13.31 per share in 2027 and then grow to $20.37 per share by 2029. If you assign a P/E ratio of 18 to those 2029 earnings, that would imply a share price of around $366, representing roughly 118% upside from current levels. Lululemon also has excellent margins for a retail apparel company. Their gross margin sits closely to 60%, while both their profit and free cash flow margins are typically between 10 and 16%. These are strong, healthy numbers that show how efficient the company is at turning revenue into profit. Another positive sign for shareholders is that Lululemon has been buying back its own shares. This is always a good signal, as it means shareholders end up owning a larger portion of the company over time and get to share the profits with fewer people. So far, the fundamentals look solid. Revenue and profits are growing, margins are strong, and management is returning capital to shareholders. The key question now is, can we buy Lululemon at a discount, or is the stock still overvalued after the drop? To answer that, I ran my DCF model. This tells us what a company is worth today based on how much cash it's expected to generate in the future. I did a 7-year analysis with low, middle, and high assumptions, and as you can see, the intrinsic value according to my bear case is $135 per share, $219 according to my middle case, and $332 according to my bull case. And because the stock is trading at around $166 per share, this means that if my low assumptions occur, you will get a 6.2% annual return on your money, middle 15.2%, and high 23.5%. And I think my assumptions are very conservative, as I have the company growing revenue between 5 and 9% over the next 7 years, averaging a profit margin and free cash flow margin between 9 and 15%, and I assigned the PM price to free cash flow at the end of the 7 years of 15, 17, and 19. I also left the share outstanding change the same, even though they have been buying back shares. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use, as I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Lululemon is currently trading at a PE of just 11, which is the cheapest valuation in the company's last decade. On top of that, they have an excellent balance sheet, with $1.1 billion in cash and only $1.7 billion in debt. For a retailer with a market cap of nearly $20 billion, that's a very comfortable financial position. Another impressive figure is the return on invested capital, which sits around 26%. That's outstanding and shows how efficient management is allocating capital and generating returns on every dollar they reinvest into the business. Now, where I see a huge opportunity is in the international growth. In the latest earnings, Lululemon reported just 1% growth in the Americas, but a massive 22% growth internationally. The CEO addressed this contrast directly, saying, "While we continue to see positive momentum overall in our international regions in the second quarter, we are disappointed with our US business results and aspects of our product execution. Of course, there are risks involved in investing in Lululemon. The main concerns right now are the slowdown in US revenue growth and decline in free cash flow. One of the reasons behind this pressure is related to tariffs and the de minimis exception, a rule that allowed products valued under $800 to enter the US without tariffs. That exemption is being rolled back, which means Lululemon will now have to pay additional import duties on some of its goods. The company estimates that the combined impact of these tariff changes will reduce their gross margin by about 230 basis points, or 2.3%. That's significant, and when you combine it with softer growth in their core US market, it makes sense that management has revised their earnings guidance downward for the year to around $12.80 per share to $12.90 per share. Now, I believe these issues are temporary and that the risk-reward profile for Lululemon is extremely attractive at current levels. The company still has strong fundamentals, a powerful brand, and significant long-term growth potential. For that reason, I've decided to start a small position in the stock and plan to dollar cost average if the price continues to decline. This way, I can gradually build my position while lowering my average cost. I hope you found this video valuable. Let me know what you think about Lululemon stock in the comments, and I'll see you in the next one.